We welcome you to our webinar this morning. We are glad to have you on board. This is one of our webinar series, and essentially today we shall be our team of analysts, esteemed research analysts will be taking us through what has happened in the last 6 months and what are the expectations in the next 6 months and beyond. And this is going to cover all asset classes, all investment options available to us. A lot has happened in the last 2 months or thereabouts with respect to the new government that was sworn in on the 29th of May, 2023. And year to date, equities market has returned over 20%. As at half-year market has returned about 15%. There has been a lot of rallies in the market across all sectors, all stocks. And people are wondering what is driving, what are the drivers of this rally. This rally is not limited to equities alone. We have seen similar rallies in the bond market and fixed income space. The same thing across all asset classes. And there are a lot of what drives market, as we know, is expectations. Expectation as regards price level, as regards new policies, and a new other changes that would come on board with the new government. We are all ears as per, we are all expectant of the new cabinet of the administration of President Bola Tinubu, and a lot of other policy pronouncements that would come on board. A few of the policy pronouncements so far have impacted the market positively as per exchange rate unification, as per the change in the CBN management, and a couple of other tax pronouncements. These are the drivers that we have seen so far. It has impacted, still impacting on various asset classes, most especially equities and fixed income. As a firm, our promise is to give you up-to-date market information, to grow your wealth in a good time, in an atmosphere of transparency, and to live that promise, to live to our brand promise as a firm. That is why we have come up with this session, to give you information, to know what you should do. Should you stay put in equities in your portfolio? Should you shed weight? Should you look to repositioning your equities as well as fixed income alike? So a lot will be laid to bear by our team of esteemed analysts. They have worked day and night to get us this information that you are yearning for. And I promise you, you would not regret spending your 2 hours or 1 hour here to get information as per what to do and direction of the market. Is with utmost pleasure that we are having you on board. And we did promise you that we are going to add value to you. We are going to grow your wealth. And that is what we promise as a firm. And to live that promise, we have brought this session for you. So please feel free to relax, listen to the analyst. I'm sure it is going to be time well spent. And we are going to also have a Q&A session when a few of those information and insights shared. You can ask questions, you can ask us, you can put across to us your questions. And once we cannot handle during this session, you can also send it across to us. We are very ready to, I would be glad to take your questions on board and provide answers and insights that would impact value and add value to you. So thank you once again for joining us this morning. And please do have a memorable moment with us, with our team, as we start the webinar proper. Thank you so much once again. Thank you.
Thank you so much, Said. Thank you for those introductory remarks. And thank you so much, our attendants and participants, for joining us. To go into the next phase of this webinar, I'll be introducing the panelists, those that will be giving us the full gist of why we're here. So first on my list, I have Sadiq Safiriyu. Sadiq Safiriyu is a chartered accountant who is a first-degree graduate from Babcock University. His experience spans across research, finance, and investment management. He is also an investment research analyst with Meristem. Second panelist to speak with us today, I have Samuel Bameke. He's a graduate of insurance from the University of Benin in Nigeria. He is also a member of Chartered Insurance Institute of Nigeria. Samuel is currently a senior investment research analyst, with Meristem Securities Limited. He leads the fixed income desk of our research team. His experience cuts across Nigeria and the sub-Saharan capital debt markets, providing recommendations and timely market intelligence. He specializes in equity research, covering insurance and industrial goods and macroeconomics. He has been able to share his wealth of knowledge via various media engagements, providing insight on financial markets and various investment opportunities. And finally, I have Damilare Ojo, who is a chartered financial analyst, a CFA charter holder. He leads the investment research team at Meristem Securities Limited. He is a seasoned analyst in macroeconomic analysis and financial markets. He has appeared as guest on several news media, providing insights into macroeconomic and financial market trends and outlook. He has helped several investors to make informed investment decisions on this media. So I would go into the conversation, and I'll start with Sadiq. Sadiq, in the first half of 2023, we witnessed moderation in inflation in the global space and an uptrend in the domestic inflation. Can you shed more light on the drivers of these macroeconomic factors and what we expect to see in the second half of the year? Sadiq, over to you.
Thank you very much, Murayo. Good morning, everyone. And as Murayo has mentioned, I will be speaking to us about the global economy and the domestic economy. So majorly, the theme in the global economy, as we've seen since the beginning of 2023, has been, deceleration in inflation rates across several economies. We've also seen, the fact that inflation is trending downward, and these economies are trying to bring it to the target range. We've seen their respective monetary authorities take the aggressive monetary stance. So majorly, during the breakout of the war between Ukraine and Russia, right? Commodity prices, energy prices, and food prices soared, to decade highs, and that made inflation rates for these economies go like multi-year highs or multi-decade highs. So now this year we've been seeing that deceleration, and we've been seeing the monetary authorities, hike rates respectively, and as such, this has impacted output growth in these economies. And there have been, increasing threats of recession across the economies. We have the likes of the United Kingdom, we have the US, we have Germany that already reported contraction in their output growth. We also have the Eurozone that reported contraction already. So these multiple series of events are what's are shaping or currently shaping the global, the global economy and the global space. And as such, we've seen, IMF and World Bank project that the global output for 2023 would be slower compared to what we saw in 2022. As such, we saw IMF predicting or projecting that the global economy will grow by just 2.8%, while World Bank projected that the global economy will grow by 2.1%, and this is lower compared to what was recorded in 2022. All right. So also when we speak around the global trade growth rates, we're seeing that majorly the reopening of China following the lockdown measures to combat the COVID has sort of improved the outlook for the growth trade for the global trade. Sorry. However, we still see that geopolitical tension, recession concerns, and also uncertainty concerning the extension of Black Sea Green Deal are sort of putting a strain on global trade outlook. So really, the projection for global economy, for the end of 2023 would be that we would be seeing slower growth rates, increasing threat of recession based on the multiple rate hikes from central the central banks of these respective economies. Moving on to the domestic economy, we have also seen output growth in Nigeria slow down, right? Especially in Q1 2023, the GDP growth rate for that period was 2.43%. And when we look at this compared to even what was recorded in 2022 full year at 3.11%, we could tell that this is slower. And there are certain events or incidents that sort of happened to experience that. We have the cash crunch that took place in around February or March. We also have the multiple rate hikes that we've been seeing from the MPC, the Monetary Policy Committee, especially in Q1 2023. We saw a 200 basis point. We saw this. You saw the committee already hike rate by 200 basis points, right? And that slowed down. But when we try to look into the dynamics of the economic growth, we have the non-oil sector and we have the oil sector. For the non-oil sector, it has been the major contributor, and this was still what happened in Q1 2023 with subsectors such as financial services, ICT, manufacturing, trade, ensuring that we recorded that growth. When we look at the oil sector part of it, while it's recorded a contraction, we still saw an improvement in it, and this majorly can be attributed to increasing oil production volume and the government's efforts to curb oil theft and vandalism. What we expect in H2 2023 is that the GDP growth would be higher in the second half of the year, and we insist on improvements in business activities in non-oil sector. As well, we expect that policies from the administration of Bola Ahmed Tinubu would help to increase oil production volume as well during the period. So for us, we're expecting that GDP for the second half of the year would be higher than what we saw in the first half of the year, and this fed into our GDP forecast for 2023. And we'll see on the slide where it says that we've revised our GDP forecast to 2.94% from an initial estimate of 2.7%. And as I said earlier, this is still lower, than what was recorded in 2022. As it relates to inflation and monetary policy, we have been seeing inflation rates trend upward. Major reason is because of higher food prices. We also have energy prices that are trending upward. It's no news that the fuel subsidy removal, has sort of also ensured that we've repriced some of our expectations for inflation. So yeah, we've been seeing inflation rates trend upward, and it is still expected to remain elevated. We have several upside risks such as insecurity in food producing regions. We have higher cost of living due to the fuel subsidy removal. It's going to impact, or it's obviously impacting fuel prices as well as transportation costs. We're also seeing the FX depreciation, feeding into prices of food and commodities. Because of the rising inflation, the Monetary Policy Committee has, utilized its major tool to try to combat the rising inflation, right? And we've seen it hike rate by 200 basis points relatively in H1 2023. Currently, we have our monetary policy rates sit at 18.5%. For us, we expect that, the Monetary Policy Committee would still hike rates, but at this point it will be less aggressive compared to what we witnessed in the first half of the year. we are predicting, or we project that the Monetary Policy Committee would hike rate by 100 basis points, right? This is to ensure that the rising inflation will be converted. Also, we estimate that the policy authority, in order to ensure that to keep the rates not so high, would also consider using other tools to control inflation, right? Tools such as the open market operation and liquidity ratio. So that's our projection for the monetary policy in the second half of the year. And when we are looking at fiscal policy, we talk about the revenue base and as well as the debt or the debt structure or the debt stock of the country. We've seen that this has been increasing for a while now. Even in the first half of the year, we saw our debt stock rise to an unprecedented level. And we still expect this to go higher. We have the recently securitized ways and means that would still, that would accumulate to the debt stock and make it rise to over 70 trillion. Again, our expectation that, while the government continue to implement, important reforms to increase its revenue base, it would try to finance its borrowings or budget deficits. It would try to finance its budget deficit through borrowings. And as such, we expect the debt stock to continue to trend upward. For the external sector outlook, we have discussions surrounding the capital inflows and how it has impacted our FX reserves. So we would see that our foreign inflows have been reducing for a while now. We could see from the charts how the downward trend that has been experienced following the COVID, following the hit of COVID, and this we are yet to see major foreign investors coming as much as we want it, and these are linked to certain bottlenecks such as FX liquidity and difficulty for the foreign investors to repatriate their funds from the country, right? We also see this, impact our FX reserve. We've seen our FX reserve also trending downward, right? So for our expectation for the foreign inflows, this in the second half of the year is that the certain reforms by the new administration would help attract investors, foreign investors into the economy. We have specifically we have the FX subsidy removal, as well we have the fuel subsidy removal, and we also have the FX depreciation or unification of exchange rates that would help attract investors into the economy. So, however, it's important to note that the implementation of these policies would not just automatically, bring these investors into the economy or make them bring their funds into the economy. There are certain things that need to be in place for this to work out. Investments into certain sectors and also increase in the revenue of the government. As it relates to foreign trade, our outlook is positive, and this is majorly aimed on improving oil production, as well as the rise in oil prices that would support the earnings and revenue, for the government. So we have a positive outlook for foreign trade. As I said earlier as well, for capital inflows, we are on the right track. However, there are still, important reforms and certain policies that need to be established in order for this to work out efficiently. These are, the several indicators, factors that we've considered for our exchange rate forecast. And, for the end of 2023, our forecast for, the Naira to USD is 779 to 786 Naira per dollar. And lastly, on the domestic economy, just give a run through of this intended policies of the new administration. And it's important to note that, on the fiscal part of it, we have the administration, mention important reforms to increase their revenue base. Majorly, we have talks around tax reforms. We've already seen certain implementation of such as the tax committee that would ensure to implement these tax reforms. We also have talks around oil theft and vandalism. While these are very interesting policies, and we believe that they would they have the potential to put the country on the right track, we still speak to the fact that there are necessary things that need to be done in order for this to be properly implemented. For oil theft now, we need, it is important that the government ensures that it speaks to security agencies to ensure that perpetrators of this fraud or crime are being caught in order for this to yield the benefits. Also, we have monetary policy. On monetary policy front, we've seen implementation such as the FX unification. Right, in the short term, as we have seen now, it's expected to, cause it's expected to strain standard of living of residents or citizens of the country. However, on the long run, right, it has the potential to help attract investors, foreign investors into the economy. And as I mentioned earlier, there are still also certain things that need to be done for all of this to yield the necessary results or the positive results that we expect, right? And lastly, on the economy front, we've seen the government talk about backward integration, as well as ensuring that the manufacturing sector is up and running in order to, support economic growth, right? This as well, in order to achieve this, you would expect that, we have increased investment into these sectors. You have technology that is operating to ensure that the players in this industry are able to benefit fully from these reforms. And as our topic has said, and as you would see from the narration, it's a tough task, bumpy road ahead, but when properly implemented, we're expected to get the propitious end. So now I'll let my next speaker speak to the financial outlook. Thank you very much.
Thank you so much, Sadiq. Thank you for that very detailed. Thank you for that very detailed presentation, Sadiq. Taking us across the global economy and honing it down into the domestic economy. Thank you once again. So for our attendees, you can drop your questions in the chat box, and then we'll take them, as the opportunity arises. Thank you so much, Sadiq Safiri, for that presentation. So my next conversation will be with Samuel Bameke. Samuel, recently, we have seen a bullish run in the fixed income and equities market, particularly in the equities market. Could this be attributed to investor sentiments alone, or are there some fundamental drivers to this? Can you enlighten us?
Hi, everyone. It's an interesting question, right? I'll get to answer in the course of conversation. All right, so I was speaking to the financial markets, but I was starting from the global equities markets to the domestic equities, and then I'll move on to the fixed income markets. All right, so taking it up from the global equities markets, the global equities market this year took a different return from what we saw last year, reversing negative return from last year, with the bulls is maintaining dominance in the market, especially despite the fears around economic slowdown and the persistent inflationary pressure that that we witnessed in the first half of this year. Major global equities indices recorded positive return. Indices by the S&P Global Market Index return about 15%. Even the MSCI World Emerging and Frontier indices also recorded a positive return. A lot of factors drove this return that we witnessed in the global equities markets. Factors such as attractive stock valuation, better than expected corporate performance, especially in tech stocks, and again, the acceleration in inflation that was witnessed in the global economy, as well as investors' expectation of a monetary pivot, in 2023, the factors that drove the market. And impressively, financial performance and then the relatively cheap valuation of tech stocks, made really attracted investors in the global economy, and that performance of the Nasdaq index, making it top performing index.
Okay, Samuel, can you hold on a bit? I think your audio needs, would you like to make your audio clearer? You might need to probably go back to start from the beginning. We're struggling to hear you. Yes.
Okay, so can you confirm you can hear me?
It could be better.
Can you confirm you can hear me now?
A lot better.
All right, thank you. Sorry for... All right, so I'll just go ahead with the presentation. Yeah, sorry for the technical glitches. So I was speaking to the global equities market. I'm speaking to the financial market, and I was talking about how the global equities market took a different turn from what we witnessed last year, and the bull, had a major dominance in the market essentially, and we saw major indices like the S&P Broad Market Index, returning positive. I mean, the S&P Broad Market Index returned about 15%. And then I spoke to, just trying to give a brief summary, I spoke to how we saw impressive performance from tech stocks, especially, which propped the performance of the Nasdaq index, making it the top performing index. I mean, the Nasdaq index returned about 31% in the first half of the year. And although in the global economy, we witnessed multiple bank collapse, and then the turmoil that they had on the financial services sector, which resulted in temporary market decline, especially in advanced markets. But however, confidence was restored in the global markets as we saw a lot of global agencies quickly responding and various interventions in the global economy. Now, looking up to the rest of the year, what's going to be our expectation for the rest of the year? We're expecting that the global equities market would sustain the positive sentiment, and this is premised on the less monetary policy stance, less hawkish monetary policy stance that we're expecting, which should lead to improved valuation, and then the likely moderation in the fixed income markets, likely moderation of fixed income yield in the fixed income markets. Again, there's the anticipation of positive corporate results, in the coming quarters, and we're expecting that this will continue to board the global equities market performance. Then again, there's this investor strong expectation in financial services and tech sector. Investors are really bullish on the financial services and tech sector. So we're expecting all of this to drive the market. However, a downside to this outlook is the looming, the concern around the looming recession in major economies. So that's the major downside that we have for the global equities market. So now moving on to the domestic equities market, the local bulls, recorded strong positive momentum during the first half of the year. I mean, as expected, in January, the market started on a positive note with the broad market index, recording gains during the first 2 months. In February, the market already returned about, the Ocean index already returned about 8%, with all sectors recording positive gain, except for the telecommunications sector and the insurance sector. However, in March and April, we witnessed mild correction in the markets. I mean, investors had to take, profit from tickers that have gained appreciably in the market. But when we entered May, we saw a change in the tide of. Now, if you recall, in our 2023 full-year outlook, we explicitly stated some factors that we think would drive the market. We stated that the ease of transition of power, investors' confidence
in the newly elected president, and immediate policy decisions would be major catalysts, for the equities market, the domestic equities market. And true to that, exactly as we predicted, that was what happened in the market. And notably, on the day after the inauguration, the market recorded the largest single gain, or I think about 5%, and that was the highest, since November. Now, other policy announcements, further help, sustain the positive mood in the market. And as by the end of H1 2023, the market already returned about 18%, outperforming its peers like Ghana, South Africa, and the MSCI frontier markets. Now, across sectorial indices, all sectors recorded positive returns except for the telecommunications sector, and the decline we witnessed as -2% that was recorded in the telecommunications sector was mainly from the sell-off that we saw on Airtel Afri. But on the flip side, the oil and gas was the best performer, propped up by buying interest on companies that played, especially in the downstream oil and gas sector, especially with the announcement of the subsidy removal. Now, speaking to foreign participation, what we witnessed in the first half of the year, during the first half of the year, foreign participation in the market, plunged to about 8 billion. That was in 8 billion naira. That was in April 2023, which was the lowest on record. And then foreign FPI participation accounted for only about 4% of the total market activity, which was also, the lowest on record the lowest on record, I mean. But however, we began to see noticeable improvements in the market in May as the value of FPI participation increased by about 11%. And that's the highest since June 2022. And that's the highest since February 2023, rather. Then again, we observed that the FPI inflow in the market was significantly higher than the outflow during the month. And that was about 2.8 times, and this is the highest we are witnessing since December 2017. And this begs the question of if this is the beginning of a new era for FPIs in the Nigerian equities market. I mean, with that in mind, that would guide us into our expectation for the rest of the year and what we are looking at for the market for the rest of the year. So for the rest of the year, for H2, we've outlined several factors that we think would drive the market for the rest of the year. And we broke them down into various segments. For the macroeconomic fundamental, we analyzed that the optimism around, the ongoing macroeconomic reforms, exchange rates, price recovery, fuel subsidy removal, CBN reforms, like Sadiq have mentioned, would drive optimism in the market. I mean, we expect that all of this would drive optimism in the market and would prompt investors to continue to take positions strategically in the market, especially for sectors that are poised to benefit from all of these changes, specifically financial sector and then the oil and gas sector. Now, we'll move on to the corporate action and equity funding bit of it. Now, we are expecting the pro-growth stance of the new government to increase investors' confidence in the market, and private investments across various sectors. So we expect more companies to continue to explore capital raise to appropriately position for market opportunities. So we expect that more companies are going to explore equity capital raise. Again, we are seeing the likelihood of recapitalization for some banks. I mean, corporate actions such as recapitalization for some banks. We are seeing the possibility of that happening in the second half of the year. Now, moving to foreign participation. In our opinion, the unification of the exchange rates, seems to be like a potential solution, to one of the most pressing FPI concerns in the Nigerian economy, which is the repatriation of funds. We expect this and other macroeconomic reforms to incentivize FPIs and then we expect gradual return on FPIs into the equities market in the coming months. On corporate performances, the effects of soaring inflation, high interest rate regime, and then currency devaluation is expected to constrain earnings of certain companies, specifically for companies that incur huge capital expenditures in dollars, for companies that import raw materials, and companies that are exposed to foreign and floating rate debt. We're expecting that this will impact their business negatively. But for companies that generate revenue in foreign currency, we have the opinion that this would be a positive for them. So for corporate performances overall, it's actually mixed. On the one hand, we're going to see negative impacts for those companies that, import raw materials in FX, and on the other hand, those that generate revenue in FX, it will be a positive for them. So it mixed. Now, speaking to the valuation, the recent rally in stock prices has led many tickers to multi-year high, but in our view, most of these tickers, especially in the oil and gas and financial sector, have found new support levels, and then they are trading at trading range. Yeah, most of these tickers have found new support levels and trading range. Now, while the equities market is performing at a premium to its peers, we do not expect significant sell-off in the market based on this elevated valuation. So on a balance of factor, our prognosis is that the market will remain largely positive, as we expect investors to continue to react to key policy changes implemented by the new administration. Now, speaking to our own valuation of the market, we had fundamental valuation of the market, and then we also used econometric, valuation of the market, and we weighted each of these factors. So we're expecting that by 2023 full year, the equities market will return about 26% by the end of this year. Now, moving on to the fixed income markets. Moving on to this fixed income market, I'll start with the global fixed income market. Now, similar to what we saw in the global equities market, the global fixed income market also reversed negative return from 2022. Yeah, from 2022. In 2022, a lot of major global physical market indices recorded, negative return, but in each one, it was a positive one. And if you look at the table below my slide, you will see across different markets, both advanced market and emerging markets, they returned positive return. Although we witnessed various volatility, during the review period, especially as a result of the banking, financial crisis, which caused jitters in the market, like I mentioned before. But however, factors like moderation in inflation and then expectation of a less aggressive monetary policy also drove the global fixed income market during the first half of the year. So this was practically the same story for advanced markets. I mean, for the US, conversations around increasing the debt ceiling, and then for the UK, the commitment of the Monetary Policy Committee to sustain their contractionary policy stance impacted the markets. So the bond yields in the US and UK rose to about 4.4% in the US and about 4.86%, thereabouts in the UK. If you looking at the emerging debt markets, I mean, the emerging debt market also returned positive, although it was divergent across countries. And then we saw a lot of trickle-down effect from the advanced markets. A lot of the dynamics that played out in the advanced market trickled down to the emerging markets, especially the hike in monetary policy, impacted the play of things in the emerging markets. Again, that was coupled with the internal issues that we have in emerging markets, issues such as foreign exchange liquidity, and debt sustainability issues that have plagued the market. All of this put together impacted the market. Now, for the rest of the year, for the global fixed income market, what are we expecting? I mean, for the global fixed income market, our prognosis is that the market would, sustain its positive return, and then we're going to see a gradual decline in yields for the rest of the year. Now, factors that we expect to drive this expectation remains the continuation of the aggressive monetary policy as central banks, continue to, battle with the sticky inflation, and then the risk of slow growth also is expected to shape the global fixed income markets. But however, we have the opinion that the yield curve will still remain inverted, and until we see a signal of a monetary pivot, we're expecting that the yield curve, will still remain inverted. Then for emerging markets, we also expect that we don't expect the emerging market to perform so differently for what it did in the first half of the year. I mean, our expectation is that the dynamics that played out, especially in the monetary side of things in the advanced market, will continue to impact the global emerging debt market. Now, moving on to our domestic fixed income market, the Nigerian fixed income markets, experienced, some volatility during the first half of the year as a result of various factors. But what we discovered is during the first half of the year for the domestic fixed income market, liquidity was a major determinant of a lot of things that played out in the market. Now, despite the downgrade weakness, Moody's credit rating downgraded us to about CAA1 at the beginning of the year. It had limited, effects on the demand for Nigerian treasury instruments. But however, surplus interbank liquidity from fact disbursement and again substantial coupon payments during the period, drove the local debt markets. Now, if you look at the dynamics in the market, the bullish momentum witnessed during that period was short-lived, due to the CBN heavy CRR debit on banks, which led to some sort of negative liquidity. And then we saw average treasury bills and bond yields reaching a year in April to about 9% and 15%, respectively. But from May, we saw, we witnessed a change in the tide of things. The new administration reforms and policies revived investors' confidence in treasury instruments. As a result, the Nigerian S&P and FMDQ, Nigerian Sovereign Bond Index, which track our Naira-denominated instruments, returned about 3%, in Q2 of the year. Now, moving to the primary markets, primary fixed income market, primary auction market, the underlying factors were alike to what we witnessed in the secondary markets. Although we experienced volatility, but again, liquidity was the major driver. Average liquidity during the period was around 322 billion. So at the start of the year, average treasury bills stop rates, was around 0.88%, and that was the lowest, recorded since 2020. And but it rose to about 6% in June. Then, speaking to the primary bond markets, we also saw stop rates, ranging between the range of 13 to about 16% stop rates in the average bond market. And then what we witnessed issuance of 3 new FGN bonds, and this is like the highest new FGN bond issuance made in the first half of the year for over a decade. And our prognosis is, the government, in a bid to manage its debt maturity profile and a lot of issues around fiscal sustainability, were the major drive for the government issuing 3 new instruments in the primary bond market. Now, speaking to our Eurobond market, the international market was active during the period, and several factors contributed to a lot of things that we saw in the Nigerian Eurobond market. At the start of the year, factors such as multiple rate hike by the US Fed, the global banking crisis, and then global economic growth outlook, impacted the markets, and as such, we saw sell-offs on our Eurobond. Our Eurobond yield, went up to as high as 11%. But however, we saw the Nigerian Eurobond market enjoy a new wave of market optimism as a result of some of the reforms of the new administration, like the fuel subsidy removal.
Okay, I think we lost Samuel. Due to network issues. Thank you to all our participants that have been dropping questions. Pending when we get Samuel back online. We have some questions in the chat box, and I know that some of my colleagues have been trying to attend to these questions. But we have a participant that asked, kindly elaborate on the drivers of this higher GDP growth, particularly in non-oil sectors. So do you think that you can provide an answer to that? This attendee wants you to elaborate on the drivers for this higher GDP growth, particularly in the non-oil sectors. So Sadiq, did you get my question? This attendee wants you to elaborate on the drivers for this high GDP growth, particularly in non-oil sectors.
Okay, so let me just take the question. Although the presentation is still go on, but to answer the question, for higher, it's important to note that for the first quarter of 2023, the GDP growth rate was lower, right? But our expectation, I would assume that the participant's question is our expectation. What actually is driving our expectation to say that we're expecting higher GDP growth for this sector in H2 2023. So yes, as I mentioned, one majorly inked on the new administration policies, right? We're seeing there are several discussions around how the manufacturing sector would benefit greatly from the policies of this new administration, increased revenue, increased investment into that sector as well, right? And there is also the fact that there is the implementation of backward integration, or statement that there would be an implementation of backward integration in this sector. So the sectors that are likely to benefit from this, we have the manufacturing sector, we have the financial services sector, ICT sector as well, we have trade sector that are going to benefit from this. So likely, these are drivers that should result into higher GDP growth in H2 2023 compared to what we witnessed in H1 2023. But overall, when we are still looking at the growth rates for 2023 as a whole, we expect it to still be lower than what we actually recorded in 2022. I hope that addresses the question.
Thank you so much, Sadiq. Thank you for that insight. And we have a question here from Mr. Festus Olaifa, that what will likely be the impact of FX policy on banks' profitability? Are the banks likely to have a positive or negative FX revaluation gains or losses? So, Sadiq, can you just give us very, very short answer to that question?
All right, yeah, very well. So just to address that as well, we said that the FX policies are going to, impact the banks. So it's actually dependent on the exposure of respective banks. So it won't affect them the same way or equally. And in our outlook, we actually dedicated a section, explaining this for the banks. And there is that part where we made analysis of the exposure of these banks. So there is a thing called the FX net long position and FX short position. So when you have, or when a bank has its foreign currency, its assets, which is in foreign currency, when it's higher than its foreign currency liability, then you say that the bank is net long. However, when the asset is less than the liability, you say it's net short. So some of the banks that as at 2022 financial, their 2022 full year financial, some of the banks that are net long, we have UBA, we have Zenith Bank, we have GTCO, and some other banks. So for them, the benefits would be increased foreign exchange trading activities and potential gains from FX revaluation. But however, for the banks that are net short, as I mentioned, based on our analysis and the 2022 full year financials that we analyzed, we have Accesscore, we have Stanbic, that net short, that net FX short position. For them, reverse will be the case, which would be that they are likely to record FX revaluation losses. All right, so that's actually the interplay on the bank's profitability. It's based on the exposure of these banks. Thank you.
Okay, thank you, Sadiq, for explaining to us that this impact will be on a case-by-case basis. So we have Samuel back, and he's just going to wrap up his presentation on fixed income. Thank you, Samuel. Please go ahead.
Thank you, Mario. Yeah, thank you for having me. All right, so I was wrapping up with our outlook for the fixed income market, I was speaking to what we think would shape the market by the end of the year. So from our prognosis, we maintain a positive outlook for the fixed income market by the end of the year. I mean, we're expecting that the fixed income market would return positive by 2023. However, we assert that year-end yields for the treasury instruments will be lower than current levels. We're expecting yields to go lower, but and this is majorly premised on the amount of liquidity that we're expecting by the end of the year. So again, for the next half of the year, we're expecting that liquidity would be a major determinant and driver. First, we've seen the removal of the cap and floor on the interbank placements, and then coupled with the drive for a less aggressive discretionary cash reserve ratio, these two things would further push system liquidity higher. So, and this liquidity that we are expecting is expected to drive yields downward, especially in the treasury bill market. Again, there's also the expectation of a less aggressive monetary tightening, which is also a contributory factor. However, we are of the opinion that the continued implementation of this economic reform and policies by the new administration would attract both domestic and foreign investors into the local debt market. So we are bullish in the fixed income market, especially for short-dated treasury notes and Eurobond. So that will be the end of my presentation. Thank you very much. Yeah.
Thank you so much, Samuel. Thank you for that detailed presentation. So the next panelist, there's an article that says that is the biggest masquerade that dances last in the festival. So Damilare, the biggest masquerade. So we've heard all of the technical, all the breakdown, the presentation from Samuel and Sadiq. So can you hone in on what strategies do you think that investors can use to position themselves for the rest of the year? I mean, looking at where we are, right? Looking at how far the year has come, and the market activities in the last, say, about a month or two, right, has been, maybe beyond some of investors' expectations, right? How can we maximize, the remainder of the year? Damilare.
Thank you very much, Mariah. And I'll say thank you to my colleagues, Sadiq and Samuel. They've already done a lot of the groundwork. And my job here is just to talk about the investment strategy, trying to tie together the different things that have been mentioned, both from the macro perspective and from the financial markets, equities and fixed income. Now, what are we expecting to, how should investors play in the equities market? Based on the expectations for the markets, as well as from a macroeconomic perspective, we are tilting more towards a growth stocks strategy or growth investing in H2 2023. Now, for a lot of our investors who might have been with us for some time, maybe from the beginning of the year, you would know that at the beginning of the year, based on what we're expecting for the first half, or fully for this 2023, we were more tilted towards value stocks. But right now, from a market point of view, volatility point of view, we think that it's going to be more beneficial to tilt towards growth stocks more than value stocks. And so we've selected stocks based on a number of criteria, which are being displayed on the screen right now. We have expectations around top line growth, that's revenue, as well as bottom line, which is earnings, omega ratio, ROE, that's return on investment, based on historical levels, as well as what we are expecting to happen in the next, for the rest of the year for some of the companies that we have. So based on that, we've selected some stocks that we think investors should be very invested in. And at this point, I will just highlight that our strategic portfolio, which is being displayed right now, is selected feeding from the criteria that we've seen before on the previous slide. And historically, our strategic portfolio is, typically outperforms the market. And even for the first half of the year, our strategic portfolio that we put out at the beginning of this year, when we did our first our outlook presentation in January, it's outperformed the market by over 18%. Yes, over 18%. So we've also then put together this, strategic portfolio for the second half of this year, which is, which contains the stocks that are being displayed right now. And as I mentioned earlier, the selection criteria is based on earnings expectations, and we also included a very important market metric, which is volatility. Because we are seeing a lot of activities already in the market, and we think that that is something that would have to remain with us for a bit of time. And Samuel also mentioned earlier that some of the stocks that we are seeing right now are getting a new support level, and we strongly believe that that is very much here to stay with us. Now, moving on to the fixed income strategy. Now, at the beginning of the year as well, we recommended a duration management strategy based on our expectations for yields at the end of the year. And pretty much, we still expect that yield is going to decline going forward. Some of the factors have already been outlined by Samuel earlier, my colleague, but I'll just reiterate or emphasize the fact that the major driver is going to be, or drivers, two major ones are going to be the less aggressive monetary policy tightening and the increased liquidity that we are expecting in the market. So based on that, in fact, right now, if you speak to a lot of money managers, you'd see that they have a lot of liquidity with them. We have some banks that have been having some CRR refund, and even for those that don't have, on a general note in the banking sector, we are having less aggressive. I mean, there's actually no longer discretionary CRR debits, which means that a lot of liquidity is being left for banks. So we think that that is going to drive yield lower by the, for the rest of this year. And based on that, we think that it is very important for investors to stay with very, very low, fixed income instruments with low modified duration, and which also have relatively high yield as of date. So, taking that into consideration, we've selected some of these fixed income instruments, which are being displayed right now. They would also be shared with all participants after now. And for those who already have a full outlook, these instruments are also clearly outlined in our in the full document. And going further to, our recommendation on Euro bonds for some African countries. We have some countries here that we've outlined, and based on different criteria from the point of view of the macroeconomic fundamentals, as well as some quantitative metrics, including 1 year default probability and our assessment of 1 year default risk, whether it is high, moderate, or low. We also considered the credit ratings of some of these countries, and based on these different metrics, we selected some African countries whose Euro bonds we are bullish on, and some that we are not bullish on. And the ones having R in the comments, R there, refers to or means recommended. So the likes of Angola, Kenya, Nigeria, Rwanda, and South Africa, we are bullish on them. We think that investors can take advantage of their Euro bonds, while the likes of Egypt, Ghana, and Zambia, as outlined here, we do not recommend them. And lastly, we went further to talk about what an ideal fixed income portfolio should look like. We have different instruments in the fixed income markets. We have Euro bonds, commercial papers, bonds, corporate bonds, treasury bills, and FGM bonds. And based on our perspective of the duration, which is also, which is a quantitative measure in fixed income investing, we've also said, outlined the ones that we think investors should overweight, or the ones that they should be neutral or should underweight. So here we recommended that euro bonds should be, should have, the investor should overweight euro bonds. And you remember on the previous slides, we've just shown some of the countries that we are most bullish on, commercial papers as well, since we are talking about taking advantage of the expectation of reduced yield at the end of the year. We think that investors should stay more on the short end of the curve, which also informed the our recommendations of the fixed income, treasury instruments that we showed earlier, which are mostly short dated or instruments that have very, their maturity is very near to where we are today. Then treasury bills as well to overweight, and FGM bonds to remain neutral on them. So that wraps up our presentation for this morning. Thank you, everyone, and I will hand over to Morayo now.
Thank you so much, Damilare. Thank you for giving us those wealth nuggets, right, on what to do and what not to do. And I remember the last time you and I were on this platform having a conversation, we were discussing margin lending, and discussing the equities market. And I know we've really drilled down into the performance so far and expectations for the year. I mean, we've seen stocks like Access touch 19 naira, UBA, touched new highs, right? So if a margin investor or someone that wants to come into the market afresh wants to take margin, right? What are the sectors? From the last time we had this conversation to now, stock prices have reached, new levels of highs, right? In the equities market, I know you've given us the recommendation and they seem, quite a number of them. Can you give like top 5 picks for a margin portfolio? If a client wants to say, okay, I want to come to Meristem to take on a margin facility because, I want to be a partaker of all these miracles, that seem to be happening since the inauguration of this new administration. Can you give us like 5 stocks that margin investors can take in for a new margin portfolio? What are the 5 top picks, top of your head, that I can recommend for a margin portfolio? I'm not putting you on the spot, disclaimer.
That's absolutely fine, Morayo. Thank you for that. And one interesting thing about that question is the fact that in our strategic portfolio, we have an intersection between the stocks that we have in our marginable securities list and the 2023 strategic portfolio. So, talking about top 5, we have a number of options to choose from as it is. We still have some stocks in the banking sector that we think that there's still pretty much upside on, even for a marginable securities. We have the likes of UBA, we have Fidelity in the banking sector, and in other sectors, the agri sector, we have Okomo Oil. We have other sectors as well. We have WAPO in the industrial goods sector, and we also have MTN in the telecommunications sector. So one interesting thing is you have sectors in different industries, and that's also, one benefit for that for investors is that you're able to diversify your portfolio. So yes, we have a couple of stocks like that, and either you check the marginable securities list or you check our outlook recommendation, the message is the same, right?
Thank you so much, Damilare. Thank you so much for those topics. There's a question here that I'd like to bring to your attention. An attendee is asking, what is the cause for the heavy sell-off in Ethel? Can you address that?
All right, Morayo. I think my colleague has already responded to that but maybe just say it briefly as well, Sha. Anyway, that the major reason is because of, before now you have a divergence in the price at which Ethel Afri is selling in Nigeria and what's selling on the London Stock Exchange. And over time, Ethel Afri is one of the 2 stocks in Nigeria that has a dual listing in Nigeria and then London Stock Exchange. So you've had arbitrage opportunity for some time, and that's one of the reasons why, or the major reasons why you've had that sell-off. But right now, we've seen a convergence of the exchange rates, and we also clearly highlighted that after that convergence, the prices at on the two markets has already converged, and there's pretty no room again for arbitrage.
Okay, thank you so much, Damilare, once again. And I know that in your recommendations for the Euro bonds, I know you mentioned Ghana, right, as not recommended, right? And we know that we've seen what happened, the default, we've seen a decline actually, 6 months decline in their inflation, right? And we've also seen their yield fall. So what can you project? Do you see Ghana coming? I know there's been communication, right? But to you, do you see a comeback for Ghana? Do you still see it as recommended, maybe in the next 1 year, 18 months or so? I know that some investors, they are taking the risk to buy them at major discounts, right? But do you see a comeback for Ghana?
Hi, Mario. So I'll just take that question. All right, so for Ghana, if you check our recommendations, not recommended. So actually, if you look at the metrics that we looked at, Ghana is still under our watch list at the moment. And that's because of, at the moment, you still have a lot of so much investor apathy towards the Eurobond. We've not seen a lot of activities, on their Eurobond, and that's because of the issues that have ensued, the restructuring of their debt, trying to get multilateral loan from the IMF, if they got in the first tranche of it for their domestic debt restructuring, and then investors are actually waiting to see what will happen with the restructuring of their foreign debt. But however, if you look at the economy, you look at inflation, we are beginning to see positives from that aspect, and you've been seeing how the government has been trying to wrap up their revenue, by working on their taxes and all that, but are trying to solve other fiscal issues, which is a positive. So at the moment, for Ghana, I know that a lot of investors would be taking the wait and see approach to see how things pan out. And for us as analysts also, we are keeping tabs on the country, trying to see how things pan out in the country. But at the moment, it's been a positive one for it's been positive for Ghana, and the reforms have been yielding benefit. I mean, we've been seeing some kind of moderation in inflation, but you can't take out that impact and effect that the restructuring would have on investors, because if you recall, a lot of investors actually were really bullish on the Ghanaian Eurobond, but after the restructuring, it caused a lot of apathy in the market. So a lot of investors, like I mentioned, would just want to take a wait and see approach and see how some of these reforms in the fiscal side of things, plays out in the near term.
Thank you so much, Samuel, for your response. I'd like for us to touch briefly, right? The new administration, we have policies coming up here and there. So do you think that the new administration's policies surrounding capital importation, do you think it is achievable?
Okay, so to address the question, do we think it is achievable? Yes, it is. What is the outlook for for capital importation or capital outflow based on the reforms? The likely impact is that it will attract foreign investors into the economy, and we can see that even when we look at the data from recent data from NGX as of May, trying to measure the foreign when you look at the foreign investment or foreign inflow into the equities market in May, you would see that it's increased very, very significantly. And what you can infer from that is we could have seen some of these foreign investors actually take position earlier, even before the inauguration of the new president. And again, what you can actually also infer from that is it's expected to continue in June. We can see the rally, very, very significant rally in June. So all of that is to tell that the reforms are achievable. The impact on capital inflows, are pretty much also achievable. However, as I mentioned during my presentation, there are still several other things that need to be in play, right? On one hand, you're seeing what I just explained is the foreign portfolio investments, which people call hot money, and you bring into the economy through the equities market or the financial market. But we also have the foreign direct investments, and when we're analyzing the Q1 2023 capital importation data, you would see that the foreign direct investment actually declined, and also the contribution of foreign investment to total capital inflow is around 4%. So what that means is that more should be done, right, by the government, investment in certain sectors in order to attract foreign investors into the economy through both foreign portfolio investments and foreign direct investments.
Okay, thank you so much, Sadiq. I know that earlier, right, in Damlari's recommendations, he mentioned the Nigerian Eurobond as recommended, right? So I'd just like to ask, does this mean that, or can we expect that the federal government would have increased revenue levels in the coming months? I mean, we know that the administration looks like a talk and do administration. So do we expect that this would reflect in the bottom line for the government of Nigeria?
I think it takes one thing to mention a policy. It takes another thing to have or to show willingness to follow through with the policy, right? And if there's anything that we've seen with this government so far, with this new administration, the President Tinubu, is that there have been actions that are speaking to being deliberate about implementing those policies. And one of the recent actions or policy direction that we've seen is the appointment of a fiscal, or of a committee to reform the fiscal and tax environment in Nigeria, which is one of the things that foreign investors have been talking about, that the tax environment is not supportive of business, and there's a need for reform around that. And when you also look at the person that has been chosen as the chairman of that committee, you would see that it also portrays willingness to actually, of course, in government, a lot of things can change in a minute, but then it's about sending a signal, right, to investors. So the signal that has been sent out is the signal of being deliberate about following through with these actions. And if rightly implemented, because the committee will give its recommendation, it's another thing for the government to implement those recommendations. And if those recommendations are being implemented, we definitely should see more willingness to pay taxes, more willingness to come into Nigeria. That's from a foreign direct investments point of view. And we should have higher tax base. We should have more effectiveness in terms of tax collections, and all of these things should lead to higher tax revenue for the government. Right.
Thank you so much, Damilare. Thank you so much for that response. I have a final question, right? And this is from our chat box. I have from Mr. Ikem Nweke. He says, good afternoon. Question for the current speaker. Please, how do you reconcile your outlook of less aggressive monetary tightening with the inflation forecast of over 30% by year end?
Hi, Maria.
Hi, Sadiq.
Okay, so as we said, we are expecting that the Monetary Policy Committee would only hike rate by 100 basis points, right, which is taking a less aggressive stance compared to what had been done in first half of the year. However, we also mentioned that the Monetary Policy Committee, we see them actually utilizing some other monetary policy tools, such as the open market operation and liquidity ratio, in order to try as much as possible to combat inflation. Away from just the monetary policy, it's also important to highlight that largely the inflation rocking Nigeria is, as we see, is cost push, right? So it's more tilted to what the fiscal authority should try as much as possible to solve, while we are saying that, yeah, the monetary authority would continue to take that position, right? It's also important that the fiscal authority should do that, and that sort of tie both of them together. So we are of the opinion that the monetary authority, would be less aggressive because the NPL has been very high. We've also seen that there has been that sort of disconnect between the NPL, even how it's tried as much as possible to combat inflation. So reforms from the fiscal authority, reforms from the new administration as well, that are ongoing, and other ones that we anticipate from them would also try as much as possible to address some structural, challenges. And this is the position that we maintain.
Thank you so much, Sadiq. I know I promised that was the last question, but I have one more question that I'm going to entertain here, and it's because it's from Tim Chang. So Tim Chang is asking, there are concerns over the attractiveness of the fixed income market given low interest rates, inflation, and Naira devaluation. What kind of reforms are we expecting?
Okay, thank you very much for the question. Now, definitely one of the things that investors look at, or foreign investors particularly look at, is the interest rate environment. But beyond that, you would also, we know that investors are very particular about certainty. Talking from the point of Naira devaluation now, certainty in terms of when you bring in your funds into Nigeria, at what price are you bringing it in? When you want to repatriate your funds, are you going to be able to repatriate, and at what price? So beyond the current metrics of inflation and what the value of Naira is, investors are very concerned about expectations, right? Expectations, in fact, many monetary policy authorities, when you hear them talk, they talk beyond what is right now. It's about inflation expectation, what investors are expecting to happen. And if you have a well-anchored expectation, that in itself is very positive to attract investors into any market, including Nigeria. So what policies would we expect amidst all of these things? I think the policies are already in place. One is that FX market has already been effectively, deregulated, if I'm going to use that word. It's now open to force of demand and supply to determine the rate. And that is, if there's anything that even the Bretton Woods institutions, including IMF and World Bank, have been saying Nigeria should, do, that is one of the things. One thing that they've been very prominent about Nigeria doing. And since that is already in place, what we can definitely expect is that our market is more attractive, and we are just secluding or just bringing out that particular reform. There are many other reforms that are ongoing in Nigeria that in themselves are enough to, to attract foreign investors into Nigeria. So I think the reforms are already in place, and we'll just get the benefits of those reforms going forward.
Thank you so much, Damilare, for your insights on that. And I'd like to say thank you to our over 200 participants in this webinar. You've talked with us so far. And for our viewers on YouTube as well, thank you so much for sticking with us this far. And our time is so fast spent. I doubt that we'll be able to attend to all of our questions here, but we can keep the conversation going. You can send your questions to us, your inquiries, your clarification. You can send them to us via email. Send them to contact@meristemng.com. And for technical related questions, you can send them to research@meristemng.com. We have very capable hands and minds available to answer your questions. Thank you once again to our panelists. Thank you, Damilare. Thank you, Sadiq. Thank you, Samuel. So at this point, I'd like to call on Okiemute. Okiemute Sagwa is a treasurer with Maristem Wealth Management Limited. Okiemute, please, can you proceed to give us the closing remarks?
Thank you, Mariah. Thank you, everyone, for taking time out from your busy schedules today to join us on our H2 Outlook webinar. You'll agree with me that it has indeed been a very insightful session, and we have gleaned a lot from the wealth of knowledge shared by our seasoned panelists. A very big thank you to Damilare, Samuel, and Sadiq for the insights that you shared. You gave us insights on the domestic and global economies. You shared predictions on what to expect, as well as implications of some of the recent policy changes that we've seen. You also showed us focus on good. You told us to focus on growth stocks. You even went into a detailed strategic portfolio. Thank you for that. You shared fixed income instruments. You told us to focus on low modified duration. You know, we learned a lot. Eurobond recommendations, the ideal portfolio, top picks for margin. In fact, it was a very, very rich session today. And I believe you've given us the juice and the sauce for the various markets. So thank you once again. We trust that the information that we've all gotten here today will guide us in making informed investment decisions in the second half of the year. A number of questions were addressed during the session, but if you have more questions, inquiries, you can feel free to contact us via various platforms. I'm sure there's also a feedback form here that will be shared for you to reach out to us, and we'll be very glad to respond to all your inquiries, because at Maristem Securities Limited, we are very passionate about growing wealth for our clients. So once again, I appreciate everyone on the call for taking time out to join us today. Thank you, and enjoy the rest of your day. Over to you, Mariah.
Okay, thank you so much, Okiemute. I mean, you've said it all. Thank you so much, participants. We can see the messages in the chat box. Thank you for joining us. Thank you for appreciating, the wealth of knowledge that we're putting out there. Thank you for also sticking with us. Thank you for being our clients. And for non-clients, I mean, this is an opportunity for you to join the winning team. Maristem Securities Limited, we are the winning team. We have all of the financial information to fulfill your needs. Whatever your investment objectives are, you are just one step away to achieving those objectives. Thank you very much once again. Like I mentioned earlier, you can reach out to us on our various platforms. You can reach out to us on our social media platform. You can send us emails. You can send to contact@maristemng.com. You can send to info@maristemng.com, and we're just more than willing to take the conversation further. Thank you once again. And let's enjoy the rest of the day and make money in the second half of the year. Thank you, everybody.
the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem. Let's grow wealth for you.
Yes, I just paid my children's school fees. Supposed to buy some shares today, but it's school fees season, you know. But just like school fees, stocks can't wait.
Life's many responsibilities come with its sacrifices, but with the margin lending facility, you don't have to miss out on your investment opportunities. Now, you can buy shares even when you are not liquid. All you need to do is have existing shares, manage funds, or cash to be used as collateral. Your marginable stocks will be calculated to determine how much you can get to buy new stocks. Remember, there is no investment without risk, but time and stocks wait for no one. Don't imagine what can be. Let the Meristem Margin Lending help boost your investments portfolio. Terms and conditions apply. Call 0700 Meristem now to get started.
Meristem. Let's grow wealth for you.